How you doing today?
I'm well. How are you?
It's almost Christmas.
I am well aware of that fact.
You're well aware of it?
I have a 3-year-old's birthday in between now and Christmas
At
also.
Christmas time?
Yeah, I didn't plan that very well.
Oh my gosh.
My bad.
That's good for you. Yeah, you should have been thinking about that. Let's see, it's March. I don't know.
Whoopsies.
Yeah.
Yeah, if only I had control over that.
I think it would be the worst thing ever to have your birthday on Christmas Day.
Oh, I have 2 family members that are
Yeah.
like the 22nd, and they always complain about it. Sorry, Bobby.
Yeah, it's be terrible because
Yeah.
you no matter what if you're a kid you're getting ripped off, right? Because you're not going to get as many gifts.
Well, yeah,
as
that's
you
the
would
thing,
have if your birthday was
like
in June.
Yeah, the list of
You know?
stuff I'm buying for
Yeah.
my kids right now is ridiculous. So I'm pulling all the way back, and
Yeah.
then they're not going to get as much.
True.
And it's just,
True.
I actually, so a lot of parents now will celebrate their kids' half birthdays in the summer just to avoid it all. Just they're like,
The half
forget
birthday
it.
thing. My kids, yeah, it's my half birthday. Whatever, don't bother me with that.
Oh yeah, that's a whole thing.
Yeah,
now.
I know. It's
Parenting
ridiculous.
is so extra.
Yeah, I
now.
know. That's ridiculous to me. I'm old school. I don't want to deal with that.
Yeah, no.
How's your what's with your mug?
Today, my mug says Bahum mug, which accurately
Good, I like
reflects
that.
my mood.
Okay. You got to get in the
So,
spirit.
I know, I really do.
You got to
But,
get in the spirit.
there's good things happening out there in the world.
Lots of good things for sure. So Omicron,
Yeah.
flash in the pan or what?
Yeah.
Markets dropped 2,000 points.
Hello,
all
goodbye.
worried about that, and then all of a sudden this week, oh, well, never mind, we're not into that anymore.
Yeah, I heard it's akin to the common cold.
Yeah,
and
it's probably going to be the next common cold.
That's
We'll have
good
another
news.
one. Yeah, it is good. It is
Hallelujah.
good. But you see how people can overreact with their anybody that sold their portfolio
Yeah.
like last week because of Omicron.
If you've been under a rock, Omicron came out, the markets tanked, a bunch of people sold off.
Yeah,
and
nobody
it
that
was-
nobody that we work with
It
sold
was
off.
so temporary.
Yeah.
A really good reminder to let those blips pass you by.
Yep, for sure. Don't respond and don't get emotional for sure.
But cool news today about I-bonds.
Yes, I-bonds. So this is a tip for you. This will be worth your money, just the money you're spending just to watch this podcast. Oh, wait a minute. They don't pay anything, right? You should.
No,
You should. After
it's
this is over,
free.
you're gonna wish that you paid.
You can send your payments to
That's right. Well, we have a
Venmo
GoFundMe thing set up. Venmo, yeah. Okay, so here's the thing. I-bonds.
Yes. What's
So
an I-bond?
An I-bond is like we all know about treasury bonds, savings bonds, Series E, double E, all those kind of things. Well, there's a Series I bond also that is tied to inflation. So right now, if you buy these I bonds between now and May 22nd, you get a 7.2% annualized return, guaranteed by the government, no state income tax.
What?
Now,
How is that?
well, that's just because they're paying inflation. They pay 0 plus the inflation rate, and the inflation rate is 7.2 over this period. So here's the quirk is you can't put all your money in it. You can put in $10,000 per year per person. So if you got a husband and wife, you can do $10,000 each.
Children?
And children can buy them also $10,000 each.
Grandkids?
Like a custodial account, grandkids, whatever.
You know, if you're about to go out and buy a
Anybody that have
Series
heart, beating
EE
heart,
for your
not
new
a
grandkid.
fetus, it has to be born. But and then you could do another 10,000 each starting in January 1st. So a couple could do 40,000 in the next 3 weeks.
So you just told everybody a place that they can stash, a couple could
40,000.
stash 20 grand, 40 grand
40 grand, yeah.
over the next 6 months and earn 7% on it.
No
For how long?
state income tax free. Well, we'll see what happens. That's for 6 months, and then the rate will change. But I doubt it doesn't look like inflation is getting that much lower by then. So it could be the same. It could even be higher for the next 6 months. You have to keep I bonds for at least a year. And so, but those are great deals. And you can also I saw a little quirk. You can apply $5,000 of your tax refund if you're getting one to buy more I bonds. You
That's
can actually
really
do
cool.
45,000.
That's really cool.
So there's your tip. Send checks. 7%.
Thank you for that. That's awesome.
I mean, it would take you probably 750 years to get 7% in your bank accounts when they're paying 0.0001% interest. So you're welcome.
That's amazing.
All right.
Okay.
So welcome to a place of possibility. I'm Richard Del Monte.
I'm Angela Wright.
We're happy to have you here. And what are we talking about today?
Today we are talking about mortgages, and we have a very special guest, Erin Ekstrum from YMAC Capital is joining us.
Yep.
You do her bio.
I will do her bio. Bring her on here. I want her to
Let's
see
bring
this.
her up. Hi, Erin.
So
Hi,
how you doing, Erin?
guys.
Nice
Great.
to see you.
How are you guys?
Thank you so much
You
for being with
too.
us today.
Yep, it's great to
You
have
bet.
you.
Thanks for having me.
You and I've been working together for 20 plus years, I think. I told Angela this morning that you first did a mortgage for me in the 1900s.
The 19, that's
I don't want to date you like that old, it sounds like a long time ago, right? Back in the day.
I was a baby. Yeah.
Yeah, right. But she did the mortgage for me, and she's been doing it forever, for 20 years for me personally. She's done some for you too, right?
Yep, sure has.
And Erin is, she's in Walnut Creek, and she is a genius. I mean, she's done some loans for me that you cannot even believe. Self-employed people, you spend your whole life trying to look like you're poor to the IRS, but then when you want to get a loan, you have to, they're like, wait, you're poor. Well, I'm not really poor, and it's just this hassle thing. But, but she's been able to walk on water multiple times for us, and so I'm really happy to have you here. So thank you.
What I like most about Erin is that she is a broker. So she can go out and shop different loans and is not behold. Like if you go to Bank of America and talk to a lender there, they can only give you Bank of America loans.
Right.
Erin can shop all the loans in the world and give you the best one.
Perfect. Yeah. Great thoughts. So we're happy to have you here. Thank you for agreeing to do this.
Yeah.
So we have some, I know you're going to get me on this.
What?
About conforming loans. She's going to hit me with, what's conforming?
Define it. So we're going to talk about all different kinds of mortgages, things that you need to be watching out for, what you should be looking for. If you've never bought a home before, we're hopefully going to give you the info that you need in order to get your loans in order for that.
Right.
And so to start, we're going to talk about different kinds of loans.
Right.
And, there are new limits on conforming loans.
Right.
You got to define that for people.
Well, let's let Erin conform.
Go, Rich. Let's see.
No, you go ahead.
This is a test.
Yeah.
You know a lot more than you're leading on to here.
Yes.
So tell us about conforming loans, what the limits are, and why you care about conforming loans or not.
Yeah, it's definitely a huge marker. So nationally speaking, the 2022 conforming loan limit, which was just announced, is at it was going to be 625, and they went a little higher, and now it's going to be like 637 or something like that. It's right around that marker, which means everyone in the country can borrow up to that limit with no restrictions and remain in a conforming loan. So conforming loans are loans that are backed by Fannie and Freddie, meaning Fannie and Freddie, I'm sure we've all heard Fannie Mae and Freddie Mac. They buy those loans. They're very stable, predictable. The guidelines are black and white, pretty simple. Okay. There's also the high balance conforming loan, which can be confusing because people are thinking, which one is the limit? But high balance is based on what county you live in. So here in the Bay Area, we tend to hit that higher conforming loan limit, which is the high balance limit. And that's at $970,000 for 2022, which is crazy.
Yeah.
I mean, that's crazy. Like almost $1 million.
No, not
no.
Here.
No. So the benefit of that, and that's county specific, right? So there's only, I can't remember the number. It's like 100-something counties in the nation that even have that county or that limit. So around here, most of the counties around here in the Greater Bay Area have it. And then you get to the outskirts where the median prices are less and it staggers down. So the benefit of the conforming loan is that you can go in with 3.5% down, 5% down, use an FHA loan, because FHA loan, which is a government loan, VA loan, which is a government loan for vets, those follow conforming loan limits. Okay. So they are based on that. They're not going to lend to you above that. There's some variance here, like if it's a 2-unit property, the conforming loan limit is higher, 2, 3, and 4. But we're speaking of single family residences. So that being said, it's crazy to me that the $970,000 you're in a conforming loan.
Yeah, that is crazy. We never would have thought. So I guess we can expect in the future to be in the Bay Area $2 million conformings at some point. I guess, right?
Yeah.
In the 20 years I've been doing this, we've seen the conforming limit go down maybe 2 or 3 years, and that was right after 2008-9 when the market was plummeting, because the limit is based on the median increase or decrease in home prices. That's why it's reassessed every year. So I refer to it as the 2022 limit because that's performing off of what happened in 2021.
Right. Okay. Great.
Makes sense.
Okay.
And so did I hear you say that if you're in a conforming loan, down payment, did I just hear you say like 2.5%, 3%, 5%?
3.5%.
3.5%.
So you're telling me that we don't have to put a full 20% down, which is like kind of the traditional view?
Yeah, I mean, when you're talking to your clients, I'm sure they're heavily discussing, do we pull money out of our investments, which involves you guys a lot. You want their money to grow over time because that's going to benefit them. And interest rates, particularly now, are so low. Why are we pulling money out of the market to invest and borrow money at 3%? That's ridiculous. So standard conventional, you can put 3% down with some products. 5% would really be the general minimum marker. You're still going to be forced with some type of mortgage insurance in that category. And that's where people talk about that 20%. Anything less than 20%, there is mortgage insurance involved. You might hear some advertisement that says 10% down, no mortgage insurance, but that's because they build the mortgage insurance into the rate. There still is mortgage insurance involved. They sell it like there's not, but there is. You're not going to get away with it in the conforming market. VA loans do not have mortgage insurance. That is, again, for vets, people who are currently serving or
and those are 0% down, right?
Yeah. Okay. VA loans, you can do 0% only on your primary residence. And you can't have more than one VA loan for obvious reasons, right? You only have one primary residence, but you can use it more than once.
Yeah.
So again, that loan fits the right borrower. Some vets think, oh, I get a VA loan and that's all I do. But sometimes if they already own the home and they're refinancing, the VA loan is not necessarily the best option anymore. You might just be in a regular conforming loan at that point.
Yeah. Gotcha. Okay. Wow. Okay, great.
So this makes home buying a lot more accessible, I think, than some people believe. I was chatting with a young client recently that was looking in the $1.5 million price range, and she thought she needed to have $700,000 to $1 million in cash in order to get the loan and buy this home. And in reality, maybe that's not the case.
Sounds like
I think some people, they look at that and they're trying to get to the conforming loan limit, or somebody has advised them to do that for some reason. Yeah. And there are reasons why maybe that person needed to do that, but probably not.
Interesting. That's great.
Yeah. Well, which kind of brings up, when people ask like, how much house can I buy? Yeah. What do you tell them?
Yeah, I feel like I should have a script on that because it's a repetitive conversation. So I might sound like a robot in my answer right now, but the answer is really, to me, much less about what they can afford as far as how much can I qualify for, more than it should be how much do I want to spend per month on my mortgage payment. And mortgage payment being not just your principal and interest, but also your property taxes and insurance, and in some cases HOA dues, because a lot of people, especially first-time home buyers, they live monthly, right? Like, what do I spend a month? And the first answer is almost always, well, I spend $4,000 a month in rent, so I can definitely afford that. That's often a go-to for people who are buying. And, I think that's important to look at that, because my answer is, you probably can qualify for a $2 million home, but do you want a $15,000 a month mortgage payment?
Yeah.
No way.
Exactly.
No way. So I tend to put it back on a much simpler question of, what are you comfortable with monthly? And sometimes that becomes a little bit more complicated conversation because they are really conservative, the way they've been living, because they've been focused on saving, right? They're saving to buy this house. Well, once you buy the house, you're not saving to buy the house anymore. So then what are you doing?
Yeah.
So that's, I kind of guide people there, and then, get into that down payment conversation, which is, you don't really need that much down, but if you want to part with all your cash, which I don't advise, let's put $1 million down. No, I'll never piggyback on that really with anybody.
Yeah.
I don't think we would either.
No.
No, we wouldn't either.
Yeah. So you're basically saying it's okay for someone to pay a little bit higher rate to put down less money because they have their money invested somewhere else, and they're probably making more than whatever the interest rate is to pay on the mortgage.
3.25%. I mean, exactly. And it's nominal. Pretty much every 5% is where you start to see the difference in rate. So, you put 5% down, 10% down, 15, 20. Sometimes people pick a number and they say, I want to put $100,000 down. And let's say that their home is an $800,000 home. Well, $100,000 is more than 10%. Less than 15%. So I tend to guide them into, let's only put 10% down, because you're not going to buy yourself a better rate with the $100,000 down. When you look at how much less your payment is with $100,000 versus 80, it's nominal. How much better would you feel with the $20,000 in your pocket? It's a huge difference. And it almost always clicks pretty quickly for people that they'd rather keep that $20,000 in their pocket.
Good. You can start remodeling the kitchen as soon as you get in, right?
Well, because y'all know what happens there.
Money on.
You're buying a house. There's plenty of things to spend money on. So let's talk a bit about pre-approval, because people go, oh, I got pre-approved. I'm like, that means nothing. They think that they're guaranteed to get the loan. That's not what it's about, right?
Like in my neighborhood, that's required to go looking at houses now.
Yeah, yeah.
So
yeah. Well, let's talk a little bit about that.
Pre-approvals are interesting. When I first started doing this, there was like a difference in terminology between pre-approval and pre-qual. We would look at somebody saying, I'm pre-qualified. And that often meant you and I got on the phone and had a conversation similar to this. I asked a little bit about your income. I asked a little bit about how much money you had. And I said, yeah, you could probably afford what you're looking for. And then you went to the pre-approval stage, which meant I might be looking at some of your documents to make sure either what you're telling me is true, or maybe you're self-employed and it's a little bit more convoluted. And I'm really, most importantly, pulling your credit at that point. Because we can have as many conversations as we want, but you'd be really surprised as to how many people's credit I pull. And either they weren't telling me the truth, which I hope is really the truth, or they didn't know what I was about to see. And it's really good we did that, because it gives us some time to correct it, which is another big piece of what often happens with first-time home buyers is we can work on, what can you do to get this better before you buy? So pre-approvals, really, like Angela said, with every offer, you're really going to need a pre-approval. But if you don't really go the step of pulling your credit, which, some larger banks, they just will kind of do the pre-qual step, you're really shooting yourself in the foot. Forget, anything else. You're shooting yourself in the foot for really knowing what's going to happen when it's time to get a loan.
Interesting. Good. Okay. What's going on with the mortgage market? Is it how are you seeing a lot of purchases, refis? What's happening?
I think it's been a really interesting 2 years. Well, COVID has been really fun for all of us, but since COVID, the markets are behaving in a way that they're moving for reasons like they never moved before. Just like you guys are saying. I loved what you were saying up front with Omicron. It's hilarious. I think it's crazy the market can do something like that off of, here's Omicron. And then we're back to business this week. I think rates are doing the same. It's ridiculous. You see them start to do something funny for not the reasons we always would watch for rates. The traditional way to watch it used to be the 10-year. And then we would talk about mortgage-backed securities. That's, a little complicated, but that's what we would follow. Now, it's really much more about, perspective of our virus. And with this virus, it's kept rates down low for a very long time. So in the 20 plus years I've been doing this, generally it's this, right? You see rates come up, they dip, they stabilize, then they come up a little bit, and then they dip down, right? And we chase the rates down. Well, this time rates have stayed low. It's given a lot of people the opportunity who maybe are procrastinators or have a more complicated situation to refinance because they've stayed low for almost 2 years now we're coming across. And that's really where we're at. It's staying low. So those who haven't refinanced since last March, do it before the rates go up, because we got nowhere else to go but up. They're not going to plummet again. And we all know purchases are just moving. And where we live, the Bay Area, I'm still seeing nothing stay on the market, and people are just hot to trot.
Mm-hmm.
Yeah. So you're basically saying that when COVID ends, whatever, if it ever ends, then you could expect mortgage rates to start tracking with the 10-year Treasury or whatever again.
Yeah, I think that when the perspective is that we have COVID under control, I think is really more rather than ending, because like you laughed, but yeah, is it going to ever end, But if it's under control and it's not a crisis, medically speaking, I think that we're going to shift back into what normally moves the markets, inflation, all those things.
Right.
Okay.
So,
and how much...
yeah, your question.
Well, how much impact does the Fed have with what they're doing on mortgage rates?
You know how that's a really common question I get. I'll get emails as soon as the Fed says we're dropping rates. And then people are like, oh, I heard they dropped rates by a quarter. There is no direct correlation between the Fed dropping the Fed funds rate and long-term fixed rates. So long-term fixed rates, like a 30-year fixed, 20-year fixed, which a lot of people don't know how exists, a 15-year fixed. Those are long-term fixed rates. ARMs, adjustable rate mortgages are not. So there is no direct correlation between the two. But what will happen is when the Fed does start to raise the Fed funds rate, they're going to do that when we're feeling like COVID is under control, inflation is under control, the risk is out of the market, and they'll start bumping that up. So in a way, there's a correlation, but not a direct correlation to what's happening to interest rates. It's more of a trend, right?
Okay.
So if a layperson wanted to follow this at all or try to get an idea of where mortgage rates might be, what should they be looking at or reading?
Oh, be careful. I mean, that's,
or just
I
don't.
would say
Call
that's
Erin.
the biggest mistake.
Yeah.
I mean, I would say that's the biggest mistake people make is, thinking, oh, I know rates are going to drop. I know rates are going to go up. I don't even know that. And I watch this stuff, every day.
Yeah.
I follow people who that's what they do for a living. So, in my opinion, I wouldn't even necessarily get into watching the 10-year or mortgage-backed securities. You could even do something as simple as type in 30-year fixed rates today. They'll give you an average, and a week later you can look at it and say, oh, it's kind of staying the same, or oh, it's coming down. Because what you see posted online, those are averages. They're not even telling you how much people are paying for those rates. That's just the average rate. So at minimum, you can at least follow the trend. Yeah. And that's the best you can do, because rates change all day, every day, just like the stock market and the price of stocks. I mean, it's the same deal.
Okay, good tips. Good tips.
You said something, and I think a lot of people don't understand this. You said people are paying for those rates. Can you talk about, the difference between 4.5% and 3.5% right now, and how you pay your rate down? Like, people really don't understand this, I think.
No, and that's what's misleading. You'll see an advertisement that says 1.99%, no closing costs, asterisk, look down below, out of pocket. So that's the misleading, right? They think, oh my gosh, no closing costs. But what is happening is they're quoting you a payment. People are sold on payments, right? They're sold on the low number of the rate, and they're sold on the payment. So they're just dumping a whole bunch of costs into the loan, which are being used to buy down your rate. We know that as paying points, origination fees. Those are the same thing. That is money you're paying up front as part of your closing cost to buy yourself a lower rate for the life of the loan. And sometimes that makes a lot of sense. I've had more people doing that in the last couple of years because we are projected here like at the bottom. So if you know you're going to stay in your loan for a while, this is the time to probably do that. Other times people tell me they're going to move in a couple of years, and I got to talk them out of doing that because they're not going to recoup that money. It's really a conversation you need to have. I love when people are like, what's the rate today? Too many options. Let's talk about you first. What's your plans? How long are you going to be in your home? Do you have kids in college? Are you going to, is there a wedding coming? Are you going to inherit money from, parents soon that you might pay down your loan? It's not as easy of like, I definitely want a 30-year fixed. People don't recognize the options out there.
Oh, interesting.
Good advice.
How do you decide whether you're going to, pay extra points or not? How much, whether it makes sense to do that or get like we were talking about getting a shorter term loan, or something, how do you decide?
How do you evaluate the numbers when you're refinancing and whether it's a good deal or not?
Yeah. Does it make sense to pay all those costs to refi, to save 0.25% or something? How do you recommend people look at that?
I mean, for me, part of that is about how long they're going to be in the loan. So if you've got somebody who says, I'm going to die here, at least that's their current plan, right? And let's say it's going to cost them $10,000 to buy a lower rate. And by spending that $10,000, again, it's not out of pocket, it's put in their loan, they are going to save $200 a month, right? So their recoup time is effectively 50 months. So if you know you're going to recoup that $10,000 over the course of 50 months, right? That's, what is that, 4.5 years, 4+ years. And you say, well, I'm going to be in the house way longer than that. Well, then that's a good deal because over time, you're going to save way more money than the upfront cost. Not to mention, you're not really writing a check for the upfront cost, right?
Yeah.
It's part of your loan.
Unless you refi again because the rates go lower.
That's right.
And
that does happen. And people then try to revert like, oh my gosh, should I refinance? I just spent 10 grand. Well, yeah, you should still refinance. You're still walking away from a a lower rate, you're like, oh, bummer. Yeah, you did do that, but it doesn't prevent you from refinancing again.
Right. Yeah.
And then I think, a lot of people who have been in loans for longer and they've been in 30-year loans and they want to start talking about moving into a 20-year loan or a 15-year loan. And often people don't say 20 years, they say 15 years because that's the more common, the 30 to the 15. I'll start talking about the 20-year because the jump in payment from a 30-year term to a 15-year term is really big.
Yeah, it's big.
If you've been in your loan for 10 years and your rate is going to drop, it might be a lateral payment move to move from your current loan to a 15-year. And if you're looking predominantly to pay off your loan versus saving money each month, so cash flow is less an issue than paying off your loan, then I would advise that 15-year. But a lot of people, when we start getting into it and talking, are really more concerned about cash flow. And so then that 30-year loan still kind of makes the most sense, especially with how low rates are. I mean, you're getting a 30-year under 3%.
Yeah. Some people, I always kind of laugh, but if you're trained as an investment advisor, then this you think about these things differently than the average layperson would. People say, well, I've already been in my mortgage for 7 years. I don't want to have 7 more years left to pay on it. It's not, you could adjust your payment to have it paid off in 23 years again, but you'll still save money.
I mean,
right?
This is when I did my last refinance with Erin. She calculated exactly how much I have to pay additional, which is still less than my old payment was, in order to pay off the loan in my original time frame. So that, I got another 30-year loan, but I'm going to pay it off early.
Yeah, so that is the best of both worlds, right? So I don't love seeing people commit to a shorter term loan unless they're absolutely certain that nothing financially or catastrophically can happen in their lives that would prevent them from making that 15-year payment. And most of the time,
that's a big point.
Yeah, Erin, in my case, that was really good advice because my financial situation changed and I got to drop my mortgage payment by a couple $100 in order to improve my budget.
That's right.
Thank you.
But
by the way, I haven't told you that.
You're welcome. But if you wanted to, you could go back when things change, adjust, and start doing that again. So it's sort of like a built-in savings plan, right? Where you get to make that choice along. And I talk a lot about that with people who have kids going to college and they know they're going to take on some tuition payments or they're going to send their kids private in high school or whatever. And so, could they totally afford that 15-year payment? Sure. But when that tuition comes, it is going to be a shock to their financial situation and they might not want to do that anymore. So don't commit to it. And then the worst thing you can do is commit to it. Then rates go up. And then you got to refinance back into a 30-year and now you got a high rate. Like, why did you do that? So, it's a pretty, when people are moving into shorter term loans, it's a much longer conversation about why you should or shouldn't do that and kind of to go over all of the reasons they need to consider.
Interesting. You've had a service for many years that I really appreciate, and I haven't seen it with any other mortgage brokers. And it's basically, I don't know the name that you call it, but basically you let us know when the rates have dropped enough that we should think about refinancing, which I think is great because not everybody follows that. Tell us a little bit about how that program works.
Yeah, so when I've worked for the same broker actually for my whole career. They've been fantastic, and working for a broker, Angela touched on that, but it allows me to offer all different kinds of products to people. Like Rich said, difficult loans, self-employed borrowers, even small business loans, commercial loans, those kind of things. So my broker kind of created just this proprietary program called Rate Analyzer, where at the end of every loan transaction, we dump the data on the rate and the loan amount and the property value of people. And we track rates. So if I were to pop it in today and say, okay, here's current rates, it would pull up for me the people who have rates that are 0.25% higher or more. And then I could see, okay, does it make sense for these people to refi? And then if it does, I can reach out to you and say, hey, it's time to refi. Here, I already have all your information. Here's why, and here's what you're going to save. And one of the things is it's a little bit trickier than what I'm saying because not always does it make sense for every person to do that. And also some people's loan situations are complicated, or I know that they were going to change jobs right after we closed, which is why we did what we did when we did it, but I know that about my clients. And so it's easy for me to contact you with pretty good knowledge of like, yeah, this is doable and it's going to be quick and easy versus like, hey, maybe this is going to work, like a random person calling me.
Yeah.
So it's really paid off over the years. It's definitely been what keeps my business ticking.
Yeah, and it's a
And
welcome
people
phone
like you.
call.
Yeah.
It's a welcome
Yeah,
phone
people
call
love
from
it.
if you're the client, you're just sitting there doing your thing, and all of a sudden,
Yeah.
hey, would you like to save $200 a month? Yeah, thank you.
Yeah.
And it's
Yeah.
much preferred to the emails I get every single day from my actual mortgage servicer, who's called Mr. Cooper or something.
Yeah, I have that too. Yeah,
You got
yeah,
Cooper
yeah,
too?
Yeah.
Yeah,
It changes
Cooper.
every other day. But, they email me like weekly, check your rates. You qualify and I just ignore them because I know Erin will tell me when the time is actually right for me.
Yeah.
What's funny is I get the same emails about mine. And the other day I got one in the mail, a letter in the mail, and it was suggesting that I refinance at a higher rate than I have.
Oh my gosh.
Brilliant.
I'm
Thank
going,
you very much.
huh? You guys have my
Waste of
loan.
a stamp.
Glad you're looking out for us.
Interesting.
Yeah,
Yeah,
great.
interesting.
Yeah.
But they're selling me the payment, right? Because I've been in my loan for a little while, so they know what my payment is, and they know what my new payment will be. So they're
I
trying to
see.
sell me on the payment like I don't know any better.
And a lot of people don't. And I would say if you're getting these letters, folks, like call an actual mortgage broker and talk it over and get a couple of quotes when you get those random letters in the mail and really read the fine print.
Yeah, read the fine print.
And the fine print is where they hide the cost, right?
Yeah.
Of course.
It's all in there somewhere. Always.
Okay, let's see. Do we have any questions from the audience? Anything up there, Liam?
Let's see.
We have one on should I pay off my mortgage? What
I bet you have
Interesting.
questions.
What would you say to that, Erin? People ask
I would
you.
have a list of questions first as to why you want to, what what your status is. I mean, most people think I'm in retirement. I don't want to have a housing payment, right? I mean, that's where they're going. I mean, my philosophy is 9 out of 10 times, it probably doesn't make sense to pay off your mortgage. I don't know how to answer it in a general answer because it is really different for every person. And some people, it's a mentality that you can't talk them out of no matter what, because they just don't want to have a housing payment. But the reality is you get the interest deduction over time. That monthly payment becomes very manageable if you've been in it for a long time. Sometimes people move out of their homes and they want to rent their homes and not sell them. And their mortgage payments are so nominal that who cares? It'll get covered by the rent. I think you guys probably even have more reasons than I do as to why you don't want to see your clients do that and part ways with their cash.
Yeah. Well,
I'd rather see them go buy another house. I'd rather see them go out there and buy another home, invest, and build their portfolios with
Me too.
that.
Agreed. Yeah,
Me
Richard,
too. I
I
agree
mean,
with
this is
you.
a perfect opportunity for you to touch again on OPM. To briefly do it.
So for me, for OPM, like I'll give you the latest example of OPM. My wife totaled her car. Well, somebody, a mail truck hit her, T-boned her in the door, wiped
She's
out
okay.
the car, and we got a big check from the insurance company. And so we were going to take the money and put it into another car for her. And we thought, wait a minute, they're willing to loan us money at like 1% for this other car.
That's right.
Why should we take that money and save 1%? We can invest it and get 7, 8, 9%, interest or rate of return, and only pay 1. We can even take the payments out of the money, right?
Yeah,
that's
out
right.
of the chunk of money, and at the end of the period when the loan's paid off, we'll have more money. From all the growth. So that's, to me, is how that works. I mean, not everybody feels comfortable doing that because it's a very, sensitive thing and it's subjective. But wow, I mean, for me, it's like
It's the same
OPM,
theory though, right?
Yeah.
They just, you're thinking, I don't want a monthly car payment. That's what you're thinking.
Right.
So you're thinking, I'd rather just pay cash. But the reality is, let's make our money work for us. I mean, that's how your clients, that's why they come to you.
Right.
I come to you and ask you questions and try to talk my husband off the ledge from selling his portfolio in stupid moments. Whoa, geez. I mean, they all do that, right? I just think that's the reality of certain people's mentality, which is okay. You can kind of do both. But don't go so extreme as to paying off. You could even just pay down your mortgage. Pay $100,000 off. Let's get your loan payment smaller. Let's move into a 30-year fixed and make your payment extremely manageable.
Yeah, that's good thinking. Good thinking. You said about saving your own money, but in this case, it's really saving somebody else's money, right? It's the insurance company's money that I'm going to earn money on. Yeah, that's the OPM. If I can get money from you at one person at 1% and pay and earn 8 or 9%, why do I ever want to pay off the 1% person? You don't. Right?
Never.
Okay. All right. Well, Erin, it's been really great to have you on. We really appreciate it. Give us your phone number and maybe your email address so people can reach out to you. If you don't reach out to her, you're really blowing it because she is amazing.
I see my number popping up here on the screen. That's my office number. But hey, I use my cell phone because, that's what we do. But my number, you can use either. It's 925-766-1352. And you can reach me by email too, Erin@wymac.com. The way my name is spelled, ERIN, and the company, WYMAC, Erin@wymac.com.
Okay.
Happy to help you, talk you through anything.
Great. And she's well worth the effort too. You're going to find she's great. Erin, thank you so much for being on. We really appreciate it.
Thanks,
guys. We have a couple of promos we have to do here for our bosses that run things here for us.
Rich is no longer the boss.
We want to promote our we have a book, Endless Inheritance, that we are offering that free. It's about helping make sure that your family works, and that the money that you create in your own life does not end up debilitating your children after you're gone.
Yes.
And also, if you have a question for us that you want to talk to us about, you can email us, and we have the email address up there. It's Richard. What is it? It's info@delmonte.
At a place of possibility.
Info@placeofpossibility.com. And then finally, if you want to have an appointment with us, we're offering free 30-minute, no obligation consultations. You can talk to us. You can go online to our website, and you can sign up for the link to pick an appointment to have with us.
Yeah.
And we appreciate that.
Yeah, that'd be great. What are we talking about next time?
We are talking about year-end financial planning.
Ooh, yeah.
Including tax and stuff. We're going to meet. We're talking, what is it? The 23rd? When are we doing this?
It's just before Christmas.
Just before Christmas. So you got 1 week left to do some planning. And there's some things you can do. And there may be a tax bill that's coming up, that may get approved. Coming out of Congress. We'll see.
People often say, what are the things I'm supposed to be doing at the end of the year? There are things.
There are some things for sure, because that's the last chance you can get to get a deduction. So that's usually the big issue.
Yeah.
And we're going to cover all that. So make sure you're there. And meanwhile, we really appreciate you being here, and thank you very much. Thank you. Remember, you're invested, and so are we. Thanks a lot. We'll see you soon.
Take care, everyone.
Bye-bye.